Hey, what's up YouTube? This is Leo with DRIPCalc, and today I want to talk about why everybody should be investing and why time in the market is more important than timing the market. Now, quick thing, this is not an investment advice. I'm not an investment advisor. This is just to demonstrate the power of compounding returns, and that even people with like not a lot of money, let's say you're 20 years old and you make a minimum wage, you can still invest, you can still put money into the market, and by the time you're near retirement, you will most likely, almost guaranteed, will have a very decent portfolio. So it's never too late to start, and the time in the market, so if you're 20, you have the time on your side, whereas like people in their 40s and 50s, they have a lot less time until retirement, and so they're at a disadvantage. So even if they have more money to invest right now, you have time, and the value of time, it will compound over the years, and you will see the great results. So with that said, let's take a look at the return of S&P 500 over the last 30 years, and this is assuming you invested $1,000 into SPY ETF. So this is S&P 500 ETF, and if you invested $1,000, a one-time investment, 30 years ago, today your gains would be 1,800, almost 1,900% on your one-time investment of $1,000, and your gains would be $18,000, almost 19. So that's completely insane. And you can see here that also this accounts for DRIP, which is reinvesting your dividends. And you may ask, well, I want to keep the dividends, but let's say you have $1,000 today, you can barely buy 2 shares of SPY. It's not even 2, it's a little bit less. And so if you look at the dividend, this is one of the highest dividends that they paid. Well, this is the highest right here, $1.90. Okay, so if you have less than 2 shares, you'll collect about $3.50 per quarter every 3 months. I mean, you can't even buy coffee with that, and it may seem small, but when you reinvest that dividend every 3 months over 30 years, that is 120 times you've reinvested dividends. And you can see over here, here's the total return. The lighter green line on the bottom, that's no DRIP, no reinvesting dividends. You can see the total return would, if you just kept the dividends, would be 1,274%. But if you reinvested that dividend, that's smaller than a cup of coffee, but every quarter, every time you get paid, you would reinvest it, you have an extra of 610% return, total return over 30 years. So that, measly $3 that you would collect today, well, not today, but if you bought $1,000 worth of SPY today, that would be your dividend, about 3, maybe 3.5. Over time, it becomes a lot of money, and in real numbers, it's actually about $6,000. So that's the power of compounding. And even though the annual compound rate is about 10.47, if you multiply that by 30, you would think, well, that's like 315%. But your total return is actually almost 1,900%, 19-fold. So, and that's the power of time in the market. Let me compare this to a 15-year investment of the same amount, $1,000, and you can see that if you invested $1,000 15 years ago, so that's half of the time period versus 30 years, your total return would be only 612%, 613. I'm talking about with the dividends reinvestment. I'm not talking about no DRIP. So 3 times less return, but you've been on the market half the time. Okay, so that just shows you that being in the market longer compounds your returns significantly. So by straight math, you would think, 15 years, 612%. That means that over 30 years, it should be 1,200, like 30%. Well, no, over 30 years, it's almost 1,900%. And that's because every time you get the dividend, it compounds, it increases the number of shares that you have, and so on and so forth. And here you can see the actual annual CAGR, annual growth, is much higher. So at 30 years, it's only 10.5%. But in the last 15 years, the annual growth has been 14%. And let me show you why. Basically, if you started investing exactly 15 years ago on this date, it's August 26, 2024. Let's open the chart for SPY. So August 24 would line up over here at in 2009. It jumps a lot, but basically like somewhere around $101 on the SPY. So that's, today it's 5.5-fold increase, but back then it was actually a really good deal, because S&P 500 basically topped out at like $155, give or take, maybe around 160 in October of 2007, and then it took a massive dive during the great financial crisis. So it went down more than 60%. And so as you were coming out of that recession, the stock market started to recover. But still, you're significantly lower on the price of SPY than it was 2 years prior to that date. Okay, so this was a great time to start investing. And that's why you have a total return of about 14% per year compounded. But even with that, even with like such a great buying point, in 15 years your return is 612%. But in 30 years, even though the stock market wasn't necessarily doing horrible, so if you look over here, it was kind of flattish. No, we gotta look at all time. So 30 years ago puts us over here in 1994, basically. Yeah, there wasn't a lot of volatility. Market didn't move a lot. In fact, like it actually went down a little bit. Yeah, it was kind of flat around $45. So yeah, it's like 10% movement at the time, but in a greater point of view, like right here, August 18, $46. So it was kind of one of the highest points before, like right over here in January 95, when it kind of went down a little bit to 45, like a couple percent move. So even though like you didn't have a massive drop down and you didn't have like a massive buying opportunity, it was just like flat. And over here you were coming out of recession and this was a great time to buy. Still, over 30 years your returns are much greater. So if we look at the 10-year returns, so between 15 and 10 years, it's only like 5 years, not that much time, but your 10-year return is just 234%, whereas your 15-year return is 612%. So that extra 5 years lets you compound like crazy. And also, again, because if you were investing the $1,000 15 years ago, that was coming out of a 2009 market crash, and that was a great time to buy. And that's why over the last 10 years, your annual return, compound return, actually drops from 14 to 12.8%. Okay, now some of you will say, well, the markets, they're too volatile, I don't like it, they go up and down, and that's true. If you look over here, in October of 2007 and until March of 2009, the S&P 500 dropped by about 60%. However, as you can see, it has recovered nicely, and over time, S&P 500 always goes up. And that's basically the premise of long-term investing, because if you believe in the US and the US economy, in the ingenuity of American companies and American people, then you should be invested in the market, because over time the market will go up. Basically, if long-term investment and planning for retirement, investing for retirement is your goal, then all this volatility over here, the 60% drawdown, the 30% drawdown, the 25% drawdown, that's actually not only not bad, it's a great investment opportunity. But even if you don't put additional money toward your portfolio, just staying in the market for a long time will yield positive results. Now, some people will say, well, I hate the volatility, blah, 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 I don't know, maybe we'll have a recession, I'll just invest in the high yield savings account or a T-bill, T-bill meaning the 3 months treasury bill, or even a 30-year treasury. So let's take a look. 30-year treasury right now is 4.1%, and the highest it's been in recent history was right over here in October of last year. It was 5.1, give or take. Now we can even look at 5 years. Yep, and still October of last year was the highest. Now, right now you will not get 5% on a 30-year treasury, it's just not possible, but let's say you were able to get 5% guaranteed for 30 years. Let's look at the compound calculator. I already calculated this, but let's say you invest $1,000 at 5% guaranteed for 30 years, and it compounds monthly. We calculate, it's already calculated, but this is your return, 346%, 347. Again, if we go back here, you invested $1,000 30 years ago, and your returns are 1,800, almost 1,900%. I think S&P 500 kind of beats 30-year treasury by a significant amount. Now, you'll say, well, it pays dividends, you reinvest. Well, yeah, and here this pays interest and it compounds. This is actually a compounded calculator. This is not even a treasury. Let's say you invest in a guaranteed 5% high yield savings account, where the money and the interest that you receive every month, it compounds, and still you only end up with 347% at the end of 30 years. Let's say you were able to get 7%. You're at 700% total return. So basically, even if you could secure an unrealistic 7% guaranteed return for the next 30 years, you're still way behind the returns of S&P 500. And this here is a pretty good demonstration of what I'm saying. this is a 3-year treasury, a 3-month treasury bill, paying about 5.25% interest, and look at the total returns. If you invested at the same amount, $10,000, $1,000, it doesn't matter. Exactly a year ago, you would end up with a total return of 5%, 5.3, whatever, and S&P 500 would return 28.5. And yes, it's been an exceptional year for S&P 500, so let's go back, let's say 5 years. I'm not sure the T-bill actually existed back then. Well, yeah. No. T-bill came about in 2022, exactly a year ago. Exactly on August 26th. Wow, this is hilarious. Why is it 2 years? It's exactly 2 years old. Okay. So anyway, in 2 years, you're up 10% on T-bill and 42.5% on SPY. Unfortunately, there's no data going back that far, but based on this calculation, we know that S&P 500 did much better. And so parking your money in a CD or in a high interest savings account, high yield savings accounts, or in treasury bills, you basically barely make even, because don't forget we had about 4% inflation. Let's call it 3% inflation. You made 2% return, because with the inflation, the 3% basically disappears due to inflation. And yes, the same is true for S&P 500, and it's kind of difficult to plug in inflation into this calculation, because government inflation reporting is sketchy at best. But nevertheless, the actual total returns of S&P 500 are much greater, and the longer you're invested, the higher your compounded returns are. Just like we can see here, 15 years buying at a very decent buying point. But yes, it was a great time to buy, but you don't know if that is a great time to buy. You don't know that the stock market will go up basically for the next 10 years. We just came out of recession over here. Well, for most people, the recession was still going on. The stock market started recovering, but the housing market did not recover until basically like 2011. And even here, you can look at SPY. From October 2007, it was 155. Yeah, so look, it took basically 6 years to just recover back to where it was in October 2007. 5.5, 6 years. So back then, investing looked kind of scary. But if you believe in America, and let's say you don't want to do like stock research, and you don't want to be bothered by thinking like, oh, what do I buy and whatnot, just investing in S&P 500 long term, you are going to make out great. And if S&P 500 goes down in 30 years, we have much bigger problem than inflation. That means the country is ruined, and most definitely it's not the case, because it's a great country with a lot of smart people, and they know how to make it better. Okay, guys, so basically, even if you can't afford a large investment up front, put in $100 a month, put in $50 a month, cut down on beer, cut down on cigarettes, cut down on going to the bar one time a month. Like, you probably spend more than $50 going to the bar once a month. Put that in the stock market. Every month, put it in the market. $600 a month, a year. Even like if you're on minimum wage, you can still afford to put $50 away each month. And I'll just show you this calculation. So let's say you put in $1,000 initially into S&P 500 and nothing monthly. You don't add anything monthly. If you do it right now, so this is the price of S&P today. This is the latest dividend and dividend growth rate and share price growth rate. Let's go for 30 years right here. Calculate. This is a straight line calculation, so obviously there will be ups and downs, but overall this is based on the historic returns. This is what you might expect to have at the end, about $23,000 after 30 years. Let's say you don't have $1,000 to invest today. Put in 100 and add $25 a month. Like, you end up with $67,000 after 30 years. And your total investment over this time, check this out, it's just $9,000. So you basically sevenfold the money that you put in, but you also don't put it in all at once. It's like a slow, very slow, gradual period. Let's say you do it for 35 years, just 5 years more, you're already at $115,000. Again, there will be ups and downs, but staying in the market, time in the market is much more valuable than timing the market. It's better to stay invested. Don't get afraid when there's a big crash. If you don't need to sell today, don't sell, because market always recovers. If you invest in individual companies, they may not recover, but the market overall always goes up. If it doesn't go up, we have something wrong in America, and it's falling apart. And that's like I said, 99.9999% will never happen. And yeah, so guys, again, this is not an investment advice, but I think that people should be invested, even if you don't know anything about the stock market. But just put in a couple of bucks into S&P 500, maybe $50 a month, whatever you can afford. You know, doesn't, obviously you should pay your bills. Probably shouldn't borrow money if you can't like afford groceries or whatever to put it in the market. But you know, if you go to a bar 5 times a month, or like even every weekend, you probably spend 50 to 100 bucks at the bar. Skip one time, no, go to the park instead, and put that 50 bucks into a stock market. And after 30 years, especially if you're young, you'll thank yourself that you actually did. So last couple of things. Once again, this is not an investment advice. If you need investment advice, you should consult a professional. This is just for informational purposes only. Guys, please smash the like button if you enjoyed this video, subscribe to the channel, and come back for more videos. When you like that video, it helps the YouTube algorithm to show our videos more, and so more people see them. And with that said, I'll see you in the next video. Peace.